G'day, mates. Have you ever invested in cryptocurrency and then had a mini heart attack when you saw the value drop? Well, don't worry because inSure has got your back. inSure is not your typical insurance company. It's community-based. That's right, you're not alone in this. It's like a support group for crypto investors, except instead of holding hands and crying, you get to keep your money safe and secure. And how do they do it, you ask? With something called a dynamic pricing model. It's like the stock market, but instead of stocks, it's insurance premiums that are changing in value. This means that if more people want to buy insurance, the premiums will go up. And if fewer people want to buy it, the premiums will go down. And you know what's even better? They use the Ethereum blockchain to keep track of everything. And if that's not enough, they also make use of Chainlink oracles, which bring outside information to the blockchain. Utilizing Chainlink oracles is like having a private investigator keeping an eye out for any dodgy activity. But wait, there's more. They're even working with Google to make sure everything runs smoothly. Talk about a power couple. And if you're worried about them not having enough money to pay out claims, don't be. They have something called a capital pool, which is like a big piggy bank. People who put their money in the capital pool can earn special tokens called inSure tokens. It's like a bonus for being a responsible adult and keeping your money safe. And if the capital pool doesn't have enough money to pay out claims, they won't let people take their money out until they get more money. Now, how does it work? The insurance is enforced through a smart contract. It automatically enforces the terms of the insurance agreement between the person buying the insurance and inSure. They use a surplus pool, which is like a big bucket of money to pay out any claims that people make. But what if there's not enough money in the surplus pool to pay out a claim? Don't worry, they've got that covered too. They'll use money from something called a capital pool, which is like another big bucket of money that people can earn rewards for contributing to. And that's not all. People who buy the insurance can also earn rewards by staking their own cryptocurrency on different websites. And inSure will share a portion of their profits with the people who stake their cryptocurrency. It's like getting paid to protect your own money.
Here comes the money!
Now, what kind of risks does the insurance cover? Well, for now, they focus on offering insurance against things like scams, devaluations, and stolen funds. But they may add more types of insurance later on if the community votes for it. But how do they figure out how much to charge people for insurance? They use something called data from past bad things that happened to decide how much to charge. They look at how likely it is that something bad will happen and how much it might cost to fix it. And if something bad does happen and you have insurance, you can submit a request for help. But hold on, it's not that easy. You have to wait for 7 days after you buy the insurance before you can make a claim. This is called a waiting period. And if you do need to make a claim, there are 3 different steps to deciding whether a claim should be approved or not. First, the person who made a claim and bought the insurance has to vote on it. Then, a group of specialists who are good at checking things, called auditors, also vote on it. If they can't agree, then anyone who has inSure tokens can vote on it. It's like a big game of democracy. If the claim is approved, then the person who made a claim will get more inSure tokens to make up for what they lost. They can keep these tokens or sell them to someone else who needs insurance. But essentially, it means it can tank the price of the inSure token to 0. You might now ask, what are the eligibility criteria to get coverage? Now, before we dive in, let's get one thing straight. No Ponzi dog coins allowed, sorry mate. And if you're getting more than 100% APY, you're on your own, cobber. But if you've got your own fungible token listed and tracked on CoinMarketCap and CoinGecko, and it's listed on at least 2 centralized exchanges, then you might be in luck. Now here's where it gets tricky. The exchange where your funds were deposited has to be tracked on both CoinMarketCap and CoinGecko, and it has to have its own token or coin listed on at least 2 other CEXs. It's like trying to keep track of all the different types of Tim Tams at the grocery store, am I right? But wait, there's more. The insurance coverage will only apply to eligible crypto assets owned by the same wallet. And you gotta prove that you actually own the devalued or stolen token or coin through a verification process. It's like trying to convince your mate that you actually caught that fish when all you've got is a blurry photo. And finally, make sure that token or coin is trading on multiple CEX and is available on CoinGecko and CoinMarketCap to be eligible for insurance claims. Because if it's not, it's like trying to sell a Vegemite sandwich to an American. So there you have it, folks.